Welcome to Volume 4 of the EMA Files. Institutions watch it. Algorithms react to it. Entire trends shift around it. The 200 EMA is often treated like a line of control in the market, a level that separates bullish territory from bearish pressure. But here's the real question. Is the 200 EMA actually predictive, or does it only look powerful in hindsight after the move has already happened? Is it truly guiding price, or are we just noticing it when it works? Today, we put to the test. In Volume 1, we focused on riding trends using the 9 and 21 EMA, learning how momentum begins to shift when faster averages cross and trends start to build. In Volume 2, we moved into pure speed with the 5 and 13 EMA, a scalping model designed to capture rapid bursts of momentum during active market sessions. Then in Volume 3, we slowed things down and focused on structure, using the 50 EMA as dynamic support and resistance to identify cleaner pullback entries within trend. But Volume 4 is different. This one isn't about speed or even structure. It's about direction. The 200 EMA is not designed to give you precise entries. Its real purpose is alignment, helping traders understand which side of the market they should actually be trading. Setting this up is extremely simple, and that's part of the power behind it. Open your chart and go to the indicators section, then search for exponential moving average and add it to your chart once. After adding it, open the settings and set the length to 200. Choose a bold, clean color, something that stands out clearly on your chart but doesn't become visually distracting. The idea is to keep your chart minimal and readable so you can immediately recognize where price is relative to this level. Once applied, you'll see a single smooth line tracking the broader market direction. And that's really all you need. Just one line doing one very specific job, helping you quickly identify the overall trend bias so you know whether you should be looking for buys, sells, or staying out of the market altogether. When price is trading above the 200 EMA, the overall market bias is considered bullish, meaning buyers are generally in control and the probability of upward continuation is higher. In this scenario, traders focus only on long opportunities rather than trying to fight the trend with short positions. The ideal setup occurs when price pulls back toward the 200 EMA after an impulsive move upward. Instead of chasing the breakout, patience is key. Wait for price to retrace closer to the EMA and show signs of rejection or strength, such as a bullish engulfing candle or a strong close back above the moving average. This reaction suggests that buyers are defending the level and using it as dynamic support. Once that confirmation appears, a buy entry can be taken. The stop loss is typically placed below the recent swing low or slightly below the 200 EMA to protect against deeper reversals. For the take profit, traders often target the previous structure high or aim for a long-term investment, allowing the trade to capture continuation within the broader trend while maintaining controlled risk. When price is trading below the 200 EMA, the market bias shifts to bearish, indicating that sellers have the dominant control over the broader trend. In this environment, the focus shifts to short setups, avoiding long trades that move against the primary direction. The setup forms when price rallies upward in a temporary pullback and approaches the 200 EMA for below. This rejection signals that the 200 EMA is acting as dynamic resistance, and sellers may be stepping back into the market. A short entry can then be taken once a bearish confirmation candle closes below the rejection area. The stop loss is usually placed above the recent swing high or slightly above the 200 EMA to manage risk if the trend begins reversing. The 200 EMA trend filter works very well on the 4-hour and daily timeframes, where the moving average reflects the true long-term market direction. On these higher timeframes, price respects the 200 EMA more consistently, making it a reliable level for identifying whether the market is in a bullish or bearish environment. On its own as a pullback model, The 200 EMA strategy produced a win rate of around 72% during testing. However, the real strength of the 200 EMA appeared when it was used as a trend filter alongside the setups from Volume 1 and Volume 3. By only taking trades that aligned with the direction of the 200 EMA, overall consistency improved and many low-probability trades were automatically filtered out. The key insight from the testing was simple. The 200 EMA isn't designed to create entries. Its real value is protecting traders from bad ones by keeping them aligned with the dominant market direction.